If we haven't met before, welcome to Understand Stock. My name is Mel. I am a principal engineer at a tech company here in San Francisco, and I am starting to make these videos about Warren Buffett's investment strategy because I've spent the last year reading a ton, listening to a ton of interviews of Warren Buffett and just deep diving into Warren Buffett's investment approach. And I'm doing these videos to help myself master this information and to distill this down so that you are able to learn from one of the world's best investors without having to put in all of the time and effort I've already put in. So welcome, and let's get started. As I covered in my last video, according to Warren Buffett, the reason to invest into a business is to get a whole lot of money back later on. But how does that actually work? How do you get money from a public company like Apple or Starbucks? How do they return money to their shareholders? Well, there are three ways that they can do that, and we're going to go through them real quickly first. The first approach is called dividends. It's where a company literally gives you cash as a shareholder. The second approach is called share buybacks, and this is where the company takes the money that they want to give back to you, and what they'll do is they'll go to the open market and buy shares for their company, and then they're going to destroy those shares so that the remaining shares are worth a lot more because they own more of the business. We're going to go deeper into this in a second. The last way is called retained earnings, and this is where the company will use the cash to grow the value of the company. And this is a little bit more complicated, and we're going to deep dive a lot more into this. Now we're going to go deeper into these, but first I want you to ask yourself a fairly fundamental question. Why do you need to understand these as an investor? Why do you need to know the different ways that a company can return money to you? Well, there are really two reasons. The first is if you don't know the different ways in which the company will return money to you, how are you going to figure out how much money the company will return to you? And if you don't know how much money the company is going to return to you, then you can't really figure out what the value of the company is over the period that you want to own it. And so if you can't do that, you can't really decide if the company is overvalued or undervalued and whether or not you should invest into the company. So in short, understanding how a business will return money to you is critical for determining the logical valuation for the company. 2, which approach the business uses to return money to shareholders actually says a lot about the management team. It actually provides us with a fairly objective way to judge their abilities without actually having personal access to them. So we're going to come back to this towards the end of the video, but just remember that the way that businesses return money to their shareholders actually says a lot about the management team. All right, so now we're going to deep dive into each of these three ways. And as I go through them, I want you to be thinking about 4 things for each one of these. 1, what are the tax implications of this approach? 2, what are the cash proceeds? Are there any cash proceeds? 3, what are the potential gains from this approach? And the flip side of this, 4, what are the potential risks of this approach? Because for some things that have potential gain, there are going to be associated potential risks. So you want to be able to understand both sides of the coin. And so keep those 4 things in mind. Again, what are the tax implications? What are the cash proceeds? What are the potential gains? And what are the potential risks? Also, as hopefully is evident, I am not a tax professional. I'm not an investment advisor. I'm not a financial advisor. So everything I'm going to be covering in this video is my current understanding of it, but treat it like entertainment. Talk to a real professional about these topics if you want to deep dive, and do your own research before you make any financial decisions. All right, now that we've got that out of the way, let's dive in. Dividends. Dividends are the most well-known way and really the simplest. Like you probably, if you've been on any kind of investment websites, researching stocks, you've probably seen the phrase dividend paying stocks or seen news that, such and such company issued a dividend. As I said earlier, it's really simple. Dividends are where a company literally takes cash and gives it back to its owners. So, for example, let's say a company decides they want to give some money back to their shareholders because it's just going to be sitting in the bank. They will take the total size of the dividend and divide it by the number of shares that exist, and they will issue that resulting amount to each of their shareholders. So, for example, if they want to return $100 million as a dividend, and there are 100 million shares that exist in total for the company, this means they're going to take the $100 million, divided by 100 million shares, and they're going to get $1 dividend per share. Really straightforward, right? So, like, let's say you own 10 million shares in this hypothetical company. That would mean like you own 10% of that company. In that case, you would get $10 million out of the $100 million dividend for the whole thing. It's really straightforward, right? Now let's talk about the 4 questions that I mentioned at the beginning. What are the tax implications of dividends? So for dividends, because they're literally just giving you cash back, that's going to be taxable income when the dividend is issued. Depending on how long you've been holding the stock, it might be taxed as normal income, or it might be taxed at like the capital gains rate. You should talk to your tax professional to understand like the taxation rules for your local area. But it just means that a company that issues $100 million in dividend, and if you own 10% of it, you'll get the $10 million dividend, but you're not really going to get the 10 million because they're going to give you the 10 million and say it's going to get taxed at a regular income rate. And let's just say you were in the 30% tax bracket. That means out of the 10 million, you're only going to be left with 7 million. And so the taxation on dividends means that whatever the amount that was supposed to get returned to you is going to get taxed, and you're going to get less of it. So keep that in mind. What are the cash proceeds of dividends? So with dividends, the company is literally giving you cash. So there is cash proceeds. And this can be a really great thing, actually. So if you're an intelligent investor and you can actually put this money to work, and put it to work actually at a better rate than the company would be able to invest it for you, then you can actually have a regular stream of fuel, essentially, for funding all of your future investment activities that you want to be doing. So, for example, in that hypothetical company that I mentioned, let's say they're issuing this $100 million dividend every quarter or every year. Now, at whatever frequency it is, that can now go towards additional investment activities that you want to do. So it can also be used for activities that are not necessarily investment related. So, for example, if you're closer to retirement age, or if your kids are about to go to college, you can actually use the dividends for really anything that you need to spend money on. So your goals might not actually be to maximize your returns, but rather to start funding your expenses. So there's cash proceeds that come from dividends, and you can use it for investment purposes or for non-investment purposes. All right, what are the potential gains from dividends? So with dividends, there aren't any major points when it comes to potential gains of the company. Your level of ownership in the company is not going to change before and after the dividend is issued. So if you own 10% of the company before the dividend, you'll own 10% afterwards as well. So nothing really notable to think about here. But what are the potential risks, like the flip side of that? Well, there are actually two potential risks to be aware of when it comes to dividends. The first is when the company issues a dividend, it is taking cash that the company had and dispersing it to shareholders. And so this means that now the company has less cash available to it. So if the management issues a dividend that they haven't really properly taken into account the amount of cash that they really actually need, this could leave the business without enough resources to do the things that it will need to do. This is an area where mistakes can be made, and when people don't consider potential things that could go wrong. For example, let's say it's an auto insurance company that normally has $1 billion in payouts per year, but COVID hits and driving just kind of plummets, right? So their actual payouts, which used to be 1 billion, might actually become 100 million. So they saved 900 million for say the year 2020. Now they have this sitting in the bank, 900 million extra in the bank. So they decide, let's give it back to our shareholders. And at the beginning of the year, there's a vaccine that is approved and people start driving again. But they don't start driving at the normal rates. They've been stuck at home. Like, they want to drive, they want to go places, they want to visit people. So they're driving twice as often as before and taking longer trips. The payout for the company rises to 3 billion because there's just a lot more activity happening and there's a lot more accidents that happen. And so the company now has to pay $3 billion. Does the company have enough money to handle that increase? If they don't, it could mean big trouble for that company. So how a company decides, or when a company decides to issue dividends, it has to look at all of the expenses that it will most likely incur, but also the expenses that might come up given the risk environment that they might be operating in. Okay, so that was dividends. Now let's move on to share buybacks. So with share buybacks, the company will use the money that they want to return to their owners to actually buy shares of the company. And then they will destroy those shares, which is also sometimes called retiring those shares or canceling those shares. This makes the remaining shares worth a lot more. So let's talk through one of the examples of how this would work. Let's say the company is currently worth $1 billion and there are 100 million shares that exist for the company. All right. And let's say you own 10 million shares, which means you own 10% of this company. The company wants to return 100 million to its shareholders, so it initiates a buyback program. They manage to buy back 10 million shares with the 100 million, and then they destroy it. Now there are 90 million shares that exist for this company. So remember, you own 10 million of these shares. You used to own 10% of the company when the company had 10 million shares, but now the company only has 90 million shares, which actually means you now own 11.11% of the company. You didn't have to spend any more money to buy more shares. There's just less shares, so now your shares are actually worth a lot more. So let's talk through the 4 questions that we talked about at the very beginning. What are the tax implications of share buybacks? This is one of the best parts about this. If you don't sell your shares and you continue to be a shareholder of a company that's doing share buybacks, there are no tax implications. The value of your shares increases, but it does not increase your tax bill. It's kind of nice, right? Like, you get more money, but you don't have to pay taxes on it. This is one of the ways of basically taking advantage of the tax rules, because technically you haven't sold that property yet. Those shares, you haven't sold them. Their value just went up. So it'd be like your house. If your house goes up in value from say $100,000 to $1 million, until you sell it, you're not having to pay extra taxes on the difference between the 100,000 and the 1 million, right? It's the same type of thing. Until you actually sell your shares, you're not actually paying taxes on when share buybacks happen because your company became more valuable. All right, so what are the cash proceeds for share buybacks? So this is also pretty simple. So there's no cash that you're getting from the company unless you're the one that's actually selling the shares. But if you're not selling, you're not getting any cash. Okay, third question. What are the potential gains from share buybacks? So this is where things get really interesting from share buybacks. So as I mentioned above, with share buybacks, you will own a bigger part of the company without making any additional investments. This part works amazingly well when it's paired with a company that has a remarkably great future ahead of it. So an example of this is Apple. So if you get a bigger portion of that great future for no additional investment, that is fantastic. What are the potential risks from share buybacks? Well, the big risk with this approach is that the company might actually choose to initiate a share buyback program when the share prices are very expensive. And this would leave you, the remaining shareholders, worse off than before the share buybacks because the money has now gone out of the business, but the amount of shares it bought back was relatively low compared to the amount of money that the company had to outlay for purchasing these shares, right? So let's talk through an example to make sense of this, and really let's take an extreme example to really drive the point home. So let's say that the company is worth $100 billion in total. We'll talk about how to value a company in a future video, but for conversation's sake, let's just say that the company is really worth $100 billion. If the company has, say, 1 million shares, that means each share is worth about $100, right? So let's say the company is trading in the open market for $250 a share. It's really worth $100, but in the open market, it is currently trading for $250 a share. Is it a good idea for the company to go use its cash to do buybacks? No, it's not. It's worth $100, but it's selling for $250. It's basically burning cash. Why would you do that, right? When you do that, it means you're leaving the remaining shareholders worse off. But let's go to the other extreme. What if the company was trading in the open market for $50 a share? It's really worth $100, but it's selling for $50. Would it be a good idea to use cash to do share buybacks? Maybe. If it didn't need the cash to do other things, buying those shares for $50 seems pretty good idea. I mean, it's like buying $1 for 50 cents. If it's worth if it's worth $100 and it's selling for $10, it becomes a no-brainer, right? At that point, the company really should be. You would judge the management team for not doing a buyback at that point in time. You'll have to understand how to value a company. That part we'll talk about in a near future video. I'm already working on it, but hopefully by now it's obvious that doing a share buyback program is not always a great idea. It really kind of depends on how much the company is actually trading for and what the real value of the company is. Looking at when a company does share buybacks is another great way of judging the management team's ability to use capital wisely. Now, that was share buybacks. Now let's look at retained earnings, our final way of companies returning money back to shareholders. And it's actually one of the more counterintuitive ones of these three, right? So retained earnings are where the company does not actually return money. Instead, what they do is they'll retain that money within the business. And I know it sounds odd. How can a company return money to shareholders while retaining it for themselves? Let's talk through this by looking at an example. let's take the same company that we've been talking through with the previous examples. Let's say they're worth $1 billion and they have $100 million in excess cash that they're wanting to return to their shareholders. So instead of issuing a dividend or doing a share buyback, they decide they're going to keep the money in the bank and they're going to use the money to fund a plan that they have to increase revenue in the company. So they currently only sell their products in the United States, and they want to actually use the 100 million to start selling their products in Europe and in Australia. They're expecting to be able to increase sales by 1 billion by reaching these new markets, which will generate approximately 200 million in gross profits per year from their estimation. In short, instead of issuing dividends or doing share buybacks, they've used retained earnings to actually significantly increase the profits generated by the company, which will make the company much more valuable. That is how the company returned money to its shareholders without really returning money to its shareholders. With the increase in value of the company through the increase in the profits in the company, the stock markets are probably going to value the shares much more highly, and so sooner or later the share prices will reflect the new value that is getting created, and so indirectly they've returned the money to their shareholders without directly handing them cash. So let's talk through the 4 questions that we've been talking about for each of the other items, right? So what are the tax implications for retained earnings? Well, that's pretty straightforward. There are no tax implications for retained earnings because you as the owner don't really get any cash. Like, no cash is changing hands at all, and so for that reason taxes don't apply. What are the cash proceeds? Again, fairly straightforward. There is no cash changing hands, and so if you need cash, this is not something you want, because you're not going to get any cash from these kind of companies that are retaining most of their earnings. Having clear awareness of what kind of company you're purchasing and what the cash proceeds of the way that they return money to their shareholders is, that you want to be very clear on that part, right? What are the potential gains from retaining earnings? This is the big one. This is the big one for this particular approach. The company has more resources to improve outcomes for the business. And if they can invest that money wisely to make significantly more money, the shareholders will benefit greatly in the future, and all of that will happen without additional resources, additional investment from the shareholders, and without the shareholders having to pay taxes on all those gains. An example of a company that does this incredibly well is Amazon. In 2012, Amazon acquired a warehouse robotics company called Kiva Systems for $775 million. So this purchase helped Amazon reduce its costs while they were growing the number of distribution centers across the company, and it enabled all of the growth that they were about to experience. So they used that $775 million to A, drive down costs, B, enable the growth that they were about to experience, and both of those things ended up benefiting the shareholders significantly over the long haul. Let's look at the flip side of this. What are the potential risks from retained earnings? There is an inherent risk that the company that is retaining earnings might not use it wisely. And if it will spend the money without really increasing the amount of money it makes, that would essentially be destroying shareholder value instead of increasing it. Again, the ability of the management team will be fully on display when evaluating the results from retained earnings. If they produce a low return on the retained earnings, or even a negative number on retained earnings, that speaks volumes about the abilities of the management team. And on the flip side, if they produce a great result on the retained earnings, wow, that's also going to speak directly to the abilities of the management of the business. All right, now that we've looked at all three of the ways that a company can return money to its shareholders, what would an ideal company look like? What kind of company would we want to own? The ideal company would be one where the management team acts rationally and chooses the best way to be able to return money to its shareholders. For example, if it's able to reinvest the earnings of the business with high levels of return and low levels of risk, it should retain as much earnings as it can use. We want the company to actually grow the earnings, especially if it can do it at a high return value with low risk, because it will do it at a tax-free rate. Like, we don't pay taxes on the money that it will retain, right? And if it can't use all the earnings at high levels of return, it should opt to actually do share buybacks if the price of the shares are below the real value of the company. And it should opt for dividends if the price of the shares are just significantly higher than the real value of the company. And so Warren Buffett has actually operated his business, Berkshire Hathaway, this particular way since its inception. And it expects all of the companies that he owns to actually operate this way as well. All right, hopefully this was useful information. We've covered 3 different ways that businesses use to return money to their shareholders. Their dividends, share buybacks, and retained earnings. We talked through the pros and cons of them and when each of those makes sense. And hopefully that was useful. And I know this is kind of foundational and maybe even basic information, but it is really crucial to actually have a clear understanding of these things as we go into the next parts that I'm going to be covering, which are basically how to use the specific information found on financial statements to be able to calculate what the value of the business really is according to the way that Warren Buffett looks at it. So I'm just trying to make sure that everybody has a good foundation and a clear understanding of how to judge a business and how to understand how much money it is actually returning to us. Because some of it can be invisible if you don't know what you're really looking for. And also some of it can be huge red flags if you miss those red flags, you're going to be in for a world of hurt later on. For example, like a company might be issuing dividends and you might be like, woo, free money. But they're setting themselves up for a huge problem. You don't want a management team like that. You don't want to be part of a company like that because yes, they issued dividends, but later on they might go bankrupt. So I wanted to make sure we cover this very early on. And in the next video, I'm going to do a little bit different. I'm not going to cover a concept, and instead we're going to dive into actually evaluating a company. We're going to go start looking at Netflix. I'm particularly interested in this because last week they experienced a huge dip in their prices, in the share prices, and I want to explore what kind of a business this is. Like, is this a business worth owning? And if it's business worth owning, what is the price that is worth paying for this, given the risks that they might be experiencing in the future? And so we're going to dive into Netflix, and I think it'll be fun. I haven't actually looked at their financials, so I'm really excited to check it out. So be sure to subscribe to the channel if you haven't yet. Turn on the notifications, blah, blah, blah. And thank you for your support. It means a lot. If this video was useful for you, please leave a comment below. Say what you liked about it, or if you didn't like the video, like, leave a comment about like what you think I can do better. This is partially for me to help me really understand these concepts very clearly, but it's also to help you learn from the best investors. So if there's something that's not clear, please let me know and I'll help clarify in a future video. Thanks.